Hey everyone, welcome back to the channel. Today we're diving deep into Chipotle Mexican Grill. Stock ticker is CMG, one of America's favorite fast casual restaurants. Chipotle is famous for serving high quality, customizable Mexican inspired meals like burritos, bowls, tacos, salads, and quesadillas. They're known for their commitment to food with integrity, which means using fresh, sustainably sourced ingredients and preparing meals without artificial colors or preservatives. Unlike traditional fast food giants like McDonald's, Chipotle doesn't franchise its restaurants. Instead, they directly own all locations, giving them tighter control over food quality, consistency, and brand image. Now let's explore if Chipotle stock is a good addition to your portfolio. Let's get started. First off, let's break down Chipotle's business model in more depth. Chipotle operates over 3,700 fast casual restaurants, primarily across the United States and a few international locations. Their straightforward menu emphasizes freshly prepared, high-quality ingredients with options fully customizable by customers, allowing for diverse dietary preferences. Chipotle maintains a strong digital presence, with approximately 35% of sales coming through their digital platforms, including their app, website, and third-party delivery services. What truly sets Chipotle apart from traditional fast food chains like McDonald's is their commitment to fresh cooking methods. At Chipotle, meals are prepared from scratch daily at each location, without the use of freezers or artificial preservatives. This unique approach positions them well within the growing market of health-conscious consumers who seek convenience without compromising quality. Their consistent focus on quality control and customer satisfaction through direct ownership of all restaurant locations enhances their brand strength and operational efficiency. Now, let's get to the juicy part. The financials. In 2024 alone, Chipotle generated $11.3 billion in revenue and a solid $2.1 billion in cash from operations. This isn't just profit on paper, it's real, tangible cash flow, making them resilient even in tougher economic climates. To visualize, imagine a big financial engine continuously pumping out cash, ready for a reinvestment or expansion. But what about their spending? In 2024, Chipotle invested around $594 million into new restaurant openings and renovations, helping expand and modernize their locations. And notably, they used around $1 billion to repurchase their own stock, returning value directly to shareholders. To understand how Chipotle turns an $11.3 billion top line into profit, we need to break down their core cost structure. Chipotle's revenue model is straightforward. They make money by selling food and beverages, either in store or digitally. But let's look at the biggest cost factors. Food, beverage, and packaging costs in 2024 were approximately $3.37 billion, or about 29.8% of their revenue. Labor costs were roughly $2.78 billion, or 24.7% of revenue. So together, food and labor account for more than 54.5% of total revenue, over half. And yet, Chipotle still manages to post industry-leading operating margins. This is thanks to strong pricing power, digital efficiency, and a simplified, streamlined menu that reduces waste and increases service speed and customer volume. That said, Chipotle's operating cost structure remains relatively high, which isn't necessarily ideal. However, the company's ability to stay profitable despite these expenses is a testament to its operational strength and loyal customer base. A critical piece investors often overlook is a company's lease obligations. Chipotle leases nearly all of its restaurants, owning only around $12.9 million worth of land, a tiny fraction of its total assets. Why lease? Flexibility, lower upfront capital requirements, and quicker expansion capabilities. As of the end of 2024, Chipotle had about $4 billion in operating lease assets, reflecting their rights to use leased spaces. Their liabilities? Approximately $277.8 million in short-term leases and $3.79 billion long-term leases, totaling about $4.07 billion. In simpler terms, Chipotle must pay around $465 million in cash leases next year alone. But with their $2.1 billion annual cash flow, covering lease payments is comfortably manageable. To make this crystal clear, here's how Chipotle lease obligations look practically. Current lease liability $277.8 million, which is due within a year. And non-current lease liability $3.79 billion. And actual cash due in 2025 about $464.8 million. So, why are the balance sheet liabilities lower than the cash due next year? Accounting rules require companies to record liabilities at a discounted present value, meaning future payments look smaller today due to discounting. Still, Chipotle generates more than enough cash each year to cover these payments comfortably. Now, let's talk valuation, specifically the intrinsic value of Chipotle based on a discounted cash flow model. We start with Chipotle's 2024 free cash flow of roughly $1.5 billion. Over the past 8 years, Chipotle has averaged an impressive 40.3% free cash flow growth rate, and we'll use that as our projection. Using a discount rate of 9% and an estimated earnings growth rate of 2.5%, the calculated intrinsic value of Chipotle's stock comes out to about $47 per share. If we apply a 20% margin of safety, the intrinsic value adjusts to around $38 per share. But here's the twist. If we assume a more conservative future free cash flow growth rate of just 10%, the intrinsic value drops significantly, down to only $28 per share. That's a massive difference and highlights how sensitive DCF models are to growth assumptions. Currently, Chipotle trades at about $51 per share, which means the intrinsic valuation suggests the stock is slightly overvalued based on this analysis. Now, is Chipotle stock a good investment? Here's the bottom line. The pros are strong cash generation, rapid growth potential targeting 7,000 North American locations, dominant digital presence, and no significant debt. The cons are, on the other hand, their business model is heavily reliant on leasing, creating long-term obligations. Also, it is vulnerable to rising ingredient and labor costs. Furthermore, their valuation appears slightly elevated based on DCF analysis. But overall, their strengths clearly outweigh potential concerns. They demonstrated financial resilience even under a theoretical 10% revenue drop scenario, still maintaining positive cash flow. Considering their strategic focus, robust financial health, and aggressive yet sustainable growth, Chipotle looks like a solid long-term investment, especially if you believe in their ability to keep customers returning for more delicious burritos. So, there you have it, a complete deep dive into Chipotle's financial health and investment potential. If you enjoyed this analysis, make sure you hit that like button, subscribe for more detailed stock breakdowns, and comment your thoughts below. Are you buying Chipotle stock? Why or why not? Thanks for watching, and I'll see you next time with another deep dive into the world of stocks. Start hustling and stay smart with your investments.